In this video, I'm going to go over how I created this table where I bucketed together each of the 4 years of an election cycle for the S&P 500 and show how each bucket performed. Let's do this. Hi, I'm Christoph Marzek. I've been a professional trader and investor for almost 20 years, and I have a mission to empower you to make better trading and investing decisions. How this all started. I follow a gentleman named Brian who is on Clear. So his channel is called Clear Value Tax. Despite it saying tax, he does a lot of investing talk. I like him a lot. He is a Chicago guy. I'm a Chicago guy. And anyways, he does a lot of good long-term type of strategies. So he recently had this video called The Stock Market's Midterm Election Pattern, 98 years of data. Okay. He talks about similar findings that I displayed here in my video. And anyways, I watched it and I'm like, you know what? Let me replicate this. Let's see if I can grab the data and do it myself. Make sure, first of all, he's accurate. And second of all, is this true? And the way you do that is I use the Shiller data set. Okay. This goes back to 1871. Everybody can go to this, and I'll put the link in the description, shillerdata.com. Here you could download the CSV or Excel file of all the data for the S&P 500. Now, worth noting, the S&P 500 was created in 1957. There's a nice little history of it here from S&P Global that talks about how it was created. And I'll also put this link in the description. Anyway, so data before that was compiled from the S&P 90 or 90 index. And before even that, before I believe 1926, when the S&P 90 was, Shiller created it basically looking backwards to recreate the S&P 500. Okay, so you don't have exact data here, right? General ideas, when you go back this far, you don't have exact data. 1871 is a long time. Nevertheless, when you export the data, you have pretty comprehensive monthly data. And if you look carefully here, 1871, the S&P 500 was $4.44 with an annualized dividend of 26 cents, which is pretty juicy compared to modern standards. Let's see. Yeah, 5.86%, almost 6% dividend yield just for owning the thing. So 1871, you probably had an outhouse to relieve yourself, but you got 5.86% dividend yield, pluses and minuses. All right, so what I then did was compile all the monthly data into annualized data, okay? Labeled it to pre-election, election year, post-election, midterm, etc. Grab the returns for that year, add in the dividend, and this could be where Brian and I potentially differ. So I'm going to show that now. Brian was showing total stock market return. I'm assuming he didn't describe this, but I'm assuming he was reinvesting a dividend quarterly. That's not what I did here. For example, I was grabbing the returns for the year and adding back in the dividend as if it came at the end of the year. Okay? There could be a reason why we have a little bit of discrepancy. Nevertheless, what I then did was pluck out each election year, right? Pre-election, election, post, etc. Put them all in a table here. Okay? And ultimately grab price returns from 1871, price returns from 1928, and I'll show you why I did that. Price returns, median and average, with dividends, without dividends, positive years versus negative years. And I did it also for 1928. Here's the summary, the uglier version. And here's the semi-prettier version. And I have my AI generated, took my data and go ahead and do something cool with it. So when looking at Brian for a moment, this is his, this is mine. We're off by a little bit. We have some consistency. Yeah, 1928. We have, for example, midterm election year were similar years positive. Election year were similar years positive. So somewhere we're off on post-election and pre-election, but also we're off on some of our average and median returns. So, and I don't quite know why that would be. Obviously, I don't have access to his data. But nevertheless, ladies and gentlemen, the message is the same. Long-term investing works. And it appears like pre-election, election year results are skewed a little bit to the upside. Maybe not even a little bit, maybe a lot of it. And nevertheless, that's, I think, the general message that market's going to go up long-term. And there's apparently 2 outlined buckets of years in the 4-year cycle where skew to the upside. Okay, that's it for this one. I hope you got some value from it. I am planning on making more content similar to this and short-term day trading type of content because that's my world professionally for 18 plus years. and long-term investing. I feel like those two flanking time frames on the timeline curve, which I have a video about this that I'll link in the description as well, is where there's edge, where you can win. And my goal, my mission is to empower you to make better short-term trading decisions, potentially have a professional career in that, and long-term investing. Okay? So I hope you have a great day, and I'll see you in the next one. Thanks.